Rachel had 11 investment accounts, 29 years old, registered nurse in Austin, Texas, $54,000 invested across 11 different funds. 11. She had followed every recommendation, chased every trending ETF, read every forum thread, watched dozens of videos like this one. A total market fund, a technology sector ETF, 2 international funds that had done nothing for 3 years, a bond fund her father recommended, 3 dividend ETFs she could barely distinguish from each other, and 4 individual stocks she was afraid to sell. 11 positions, 11 sets of fees, 11 quarterly statements she had stopped reading. Then one evening, Rachel sat down and actually calculated what her 11 positions had returned over the previous 5 years. She added every balance, subtracted every contribution, ran the annualized return calculation. Her 11-fund portfolio, 6.8% annualized return. Over the same 5 years, the S&P 500 returned 14.3% annually. Rachel had not beaten the market. She had not matched the market. She had earned less than half of what a single basic index fund would have paid her if she had done absolutely nothing except buy it and leave it alone. 11 funds, hundreds of hours of research, years of anxiety about allocation and rebalancing and whether she owned enough international exposure for 6.8%. That evening, Rachel closed 10 of her 11 accounts, consolidated everything into 3 ETFs, 1 to anchor, 1 to grow, 1 to pay her while she waited. She has not touched the portfolio since. Today, I am going to show you exactly what those 3 ETFs are, why they work together in a way no single ETF can replicate, the specific numbers behind each one, how $10,000 grows to $560,000 in this portfolio, and how $10 a day, the cost of 2 coffees, becomes $1,364,000 over 30 years. But before the portfolio, I need to show you the gap that makes complexity so dangerous. Because Rachel's story is not unusual, it is the default outcome for investors who follow too much advice from too many directions simultaneously. Here is the number that should make every investor uncomfortable. The average equity fund investor earns approximately 3% to 4% less annually than the fund they are invested in. Not because the fund performs badly, because the investor does. They buy after strong performance. They sell during downturns. They rebalance at the wrong moments. They second-guess allocations and move money between funds at precisely the wrong times. Morningstar calls this the behavior gap, the gap between what the fund returns and what the investor actually receives. More positions means more decisions. More decisions means more opportunities to make behaviorally driven mistakes. Rachel's 11-fund portfolio did not underperform because she picked bad funds. It underperformed because 11 funds created 11 separate sources of anxiety and 11 separate temptations to do something at the wrong moment. 3 funds fixes this. Not because 3 is a magic number, because 3 is the minimum number required to cover the 3 jobs a complete investment portfolio must do. 1 job, anchor your wealth against market volatility. 1 job, grow your wealth aggressively over time. 1 job, pay you income while the other 2 do their work. 3 jobs, 3 funds, nothing else required. Here are the 3 funds Rachel chose. ETF One, VTI, the anchor. Vanguard Total Stock Market ETF. VTI owns the entire United States stock market, not the largest 500 companies, not a specific sector. Every publicly traded American company, all 3,500 plus of them, in a single fund. When you buy VTI, you are not making a bet on any company, any sector, or any trend. You are making one single bet. The American economy will be larger 30 years from now than it is today. That is the only bet VTI requires you to make. And historically, it has been one of the most reliable long-term bets available to any investor at any income level. When technology pulls back, healthcare may carry the weight. When consumer stocks struggle, industrials might pick up the slack. When one sector faces headwinds, 3,500 other companies absorb the impact. This natural diversification is what makes VTI your anchor, not your fastest growing position, not your income generator, your anchor. The fund that holds its value through recessions, through crashes, through whatever the next crisis looks like that nobody has named yet. Expense ratio, 0.03%. On $100,000 invested, you pay $30 per year, less than a single restaurant meal to own the entire American stock market. The numbers for VTI. Annual price appreciation, 12.45%. Dividend yield, 1.13%. Dividend growth rate, 6.16% annually. What $10,000 in VTI looks like over time. Year 1, $11,358. Year 10, $34,830. Year 20, $117,350. Year 30, $387,355. Total value added to original investment, $377,355, of which capital appreciation accounts for $368,471, of which reinvested dividends account for $8,884. VTI versus VOO is a debate that consumes enormous amounts of investor time and energy. Here is the honest answer. Over any 10-year period, the difference in returns between VTI and VOO has been less than 0.2% annually. The small cap and mid cap exposure that separates VTI from VOO has occasionally added performance and occasionally subtracted it, never meaningfully in either direction. The real reason to choose VTI over VOO has nothing to do with returns. It is completeness. VTI owns companies before they become large enough for the S&P 500. Some of the biggest compounders in market history spent years in small and mid-cap territory before the S&P 500 added them. VTI captured that growth. VOO did not. For a 30-year portfolio, that early capture of future large caps is a genuine structural advantage. Small, but real. ETF Two, QQQ, the growth engine. Invesco QQQ Trust. The original three-fund portfolio used international stocks for this slot. The logic was sound in 1990. Different countries perform differently at different times. International exposure smooths out volatility and captures growth outside America. That logic has not held up. Over the last 15 years, the MSCI World ex-USA Index has returned approximately 5.2% annually. QQQ has returned approximately 19% annually over the same period. The reason is simple and important. The largest American technology companies are not American companies in any meaningful sense. Apple generates more revenue outside the United States than inside it. Microsoft's cloud infrastructure runs businesses on every continent. NVIDIA's chips power AI data centers in Singapore, London, Frankfurt, and Tokyo. If you own the top American technology companies, you already own the companies winning the global growth race. An international fund gives you geographic diversification. QQQ gives you the companies actually driving global growth. For this slot in 2026 and beyond, that is the more valuable bet. QQQ tracks the NASDAQ 100, the 100 largest non-financial companies listed on the NASDAQ exchange. Semiconductors, artificial intelligence, cloud computing, digital advertising, biotech, e-commerce. Not speculative startups hoping to figure something out. Profitable, cash-generating businesses that dominate their industries globally and have done so over a decade. QQQ moves faster than VTI. When markets fall, QQQ can fall harder. When markets recover, QQQ tends to recover faster and stronger because the companies inside it emerge from downturns with larger market positions than they entered with. Expense ratio, 0.20%. The numbers for QQQ. Annual price appreciation, 19%. Dividend yield, 0.46%. Dividend growth rate, 9.73% annually. What $10,000 in QQQ looks like over time? Year 1, $11,946. Year 10, $58,441. Year 20, $336,810. Year 30, $1,920,977. Nearly $2 million from a single $10,000 investment. Total value added, $1,910,977, of which capital appreciation accounts for $1,905,620, of which reinvested dividends account for $5,357. The 19% annual return figure is accurate as a historical average, but here is the context that matters before you size your QQQ position. In 2022, QQQ fell approximately 33%. A $100,000 position became $67,000 in 12 months. If you had $300,000 in QQQ, you watched $99,000 disappear in a single year. The 19% average includes years like 2023, where it returned 55%. It also includes years like 2022, where it returned negative 33%. The investor who held through 2022 into 2023 captured both. The investor who sold during the 2022 drawdown captured only the loss. This is why QQQ cannot be your only fund. Paired with VTI's stability and SCHD's income, the 2022 scenario looks completely different. While QQQ was falling 33%, SCHD fell approximately 3%. VTI fell approximately 19%. The combined portfolio declined meaningfully, but not catastrophically. And the SCHD dividends kept arriving every quarter, providing psychological and financial ballast through the entire drawdown. That combination is why all three funds belong together, not as separate strategies, as a single integrated system. Here is the number that changes how most investors think about income. $1,694 per month. Passively, from a single ETF, after 30 years of consistent investing. Stay with me for the next 5 minutes because the third ETF in this portfolio is the one that most growth-focused investors completely underestimate until they actually run the income projections. ETF 3, SCHD, the Income Engine. Schwab U.S. Dividend Equity ETF. The original three-fund portfolio used bonds for this slot, and for decades that made sense. Bonds provided stable income and smoothed out equity volatility. Steady interest payments during market downturns kept investors from panic selling their stocks. But bonds have a fundamental ceiling. You lend money to a government or company. They pay you a fixed rate of interest. That rate does not grow. When inflation rises, your real return shrinks. When rates change, your bond value changes. And unlike equities, bonds do not compound in any meaningful way over long periods. SCHD replaces the bond slot not by replicating what bonds do, but by doing something structurally better. SCHD screens approximately 2,500 companies through a 4-part quality filter: free cash flow to total debt, return on equity, dividend yield, 5-year dividend growth rate. Every March, the entire fund goes through a quality inspection. Companies that no longer meet the standards get removed without exception. What you are left with is approximately 100 businesses that consistently generate more cash than they need and share a meaningful and growing portion of that cash with shareholders every single quarter. Consumer staples, healthcare, industrials, financials, businesses that people need in recessions, in booms, in pandemics. Companies whose earnings are stable enough to keep increasing dividends through multiple market cycles. SCHD versus bonds. A bond pays you a fixed rate and stops. SCHD pays you a dividend that grows every year. In year 1, SCHD's 3.59% yield is already 3 times what a 10-year treasury was yielding in most recent periods. In year 10, that dividend has grown at approximately 10.61% annually. In year 20, the income has compounded to something a bond can mathematically never replicate. And unlike a bond, SCHD's underlying assets also appreciate in value. 3 benefits from one fund: growing income, portfolio appreciation, defensive stability during downturns, versus 1 benefit from a bond: fixed interest income. Expense ratio, 0.06%. The numbers for SCHD: annual price appreciation, 8.92%. Dividend yield, 3.59%. Dividend growth rate, 10.61% annually. What $10,000 in SCHD looks like over time. Year 1, $11,231. Year 10, $32,740. Year 20, $113,469. Year 30, $422,014. Total value added $412,014, of which capital appreciation accounts for $264,920, of which reinvested dividends account for $147,094. The dividend growth rate of 10.61% annually is the single most underappreciated number in this entire portfolio. Here is why it matters so much. In year 1, $10,000 in SCHD generates $359 in dividends. In year 10, at 10.61% annual dividend growth, that same $10,000 now generates $977 in dividends, even if the share price never moved. In year 20, it generates $2,739 in dividends annually. In year 30, it generates $7,576 in dividends annually, from a $10,000 initial investment. This is not portfolio growth driving the income. This is the dividend itself growing, independent of whether the share price moves. The compounding dividend is a second growth engine operating completely separately from price appreciation. Most investors look at SCHD's 8.92% price appreciation and compare it unfavorably to QQQ's 19%. They are comparing 2 different things. QQQ's return is almost entirely price appreciation. SCHD's return includes a compounding dividend engine that operates whether markets are rising or falling. In a flat market year where QQQ returns 0%, SCHD's dividend still arrives every quarter. In a down market year where QQQ falls 33%, SCHD's dividend still arrives every quarter. The income stream is not correlated to price performance. That independence is what makes SCHD genuinely irreplaceable in this portfolio. Here is how Rachel built her three-fund portfolio. Equal allocation across all three. $3,333 into VTI. $3,333 into QQQ. $3,333 into SCHD. The combined portfolio metrics. Blended dividend yield, 1.66%. Blended dividend growth rate, 8.83% annually. Blended price appreciation, 13.46% annually. What $10,000 across all three looks like. Year 1, $11,512. Year 10, $39,840. Year 20, $151,525. Year 30, $560,970. Annual dividend income at year 30, $2,680. Monthly passive income at year 30, $223. Total value added from $10,000, $550,970. That single $10,000 investment beats the average American retirement savings of $334,000 by $226,000. From doing nothing except buying 3 ETFs and leaving them alone for 30 years. The $10 a day scenario. What if you do not have $10,000 to start? Here is what investing $10 a day, $3,650 per year, into this exact portfolio looks like. Year 1, portfolio value, $3,650 contributed. Year 10, $73,840. Year 20, $349,627. Year 30, $1,364,774. Over $1 million from $10 a day. Total contributions over 30 years, $109,500. Portfolio builds the remaining $1,255,274. Annual dividend income at year 30, $5,180. Monthly passive income, $418. The average American saving $334,000 for retirement over a career. This portfolio at $10 a day delivers 4 times that figure. 4 times from a daily coffee budget. Here is what most three-fund portfolio videos skip. Equal weight is not always optimal. The right allocation depends on one honest question about where you are in life. If you are under 35 with no immediate income need, consider 40% QQQ, 40% VTI, 20% SCHD. Maximize growth while time is on your side. SCHD's behavioral anchor is still valuable, but growth should dominate early. If you are between 35 and 50, consider 33% QQQ, 34% VTI, 33% SCHD. Equal weight balances growth in income as your retirement horizon comes into focus. This is Rachel's allocation. If you are over 50, consider 20% QQQ, 30% VTI, 50% SCHD. Income becomes the priority. SCHD's growing dividend protects purchasing power. Reduced QQQ exposure limits sequence of returns risk as retirement approaches. There is no wrong answer. There is only the allocation that matches where you actually are, rather than where you wish you were. Here is the insight that makes this portfolio genuinely different from just owning QQQ alone. When markets crash, and they will crash, possibly multiple times over your 30-year horizon. The three-fund portfolio gives you three separate anchors against panic selling. VTI tells you, I own the entire American economy. It has survived every recession in history. It will survive this one. SCHD tells you, my dividends are still arriving. The income continues regardless of price. I am being paid to wait. QQQ tells you, these companies have recovered from every previous crash and emerged stronger. Those three separate narratives make it psychologically far easier to stay invested during the periods that determine long-term outcomes. The investors who stay invested through the 33% drawdowns capture the 55% recoveries. The investors who sell capture only the loss. The three-fund portfolio is not just an investment strategy. It is a behavioral system designed to keep you invested through every condition that would otherwise make you do the wrong thing at the wrong moment. Rachel still has 3 ETFs: VTI, QQQ, SCHD. Equal weight, automatic monthly contributions, dividends reinvesting automatically. 0 additional decisions required. She has not rebalanced in 8 months. She does not check her allocation weekly. She does not read quarterly reports. She checks her portfolio twice a year, confirms the automatic contributions are running, reviews the annual dividend income growth. That is the entire management requirement of a three-fund portfolio. The simplicity is not a compromise. It is the strategy. Because the investor who does less almost always outperforms the investor who does more. Rachel's 11-fund portfolio returned 6.8%. Her 3-fund portfolio has returned consistently above the blended 13.46% average since she consolidated. Same investor, same market, half the complexity, nearly double the return. One action, this week, before anything else. Count how many investment positions you currently hold. If that number is above 5, calculate your actual annualized return across your entire portfolio for the last 3 years. Then compare it to what VTI alone returned over the same period. Post the result in the comments. Did your complex portfolio beat simple VTI? Yes or no? No judgment, no wrong answers. Just investors being honest about whether complexity is actually earning its keep. If this video simplified how you think about building long-term wealth, subscribe to this channel. Every week, we break down investment strategies using real numbers and real data so you can make better decisions with your money. Next week, we are going even deeper. We are revealing the exact dividend portfolio that generates $4,000 a month in passive income starting from as little as $20 per day. 3 strategies, real projections, the complete breakdown of what actually works. Subscribe, hit the notification bell, and share this video with any investor who is holding more than 5 positions and wondering why their returns do not match the market. Because the answer is almost always complexity. And the solution is almost always simpler than anyone wants to admit. See you next week.